If you've got rental income but the tax returns don't look great on paper, a DSCR loan might be the only way you're getting financed. And honestly, for a lot of investors I talk to, it's also the faster way. W-2 income and tax returns are out. Rent covering the payment is in. In the next 5 minutes, I'll break down how DSCR loans actually work, current rates, and what lenders really look at, and how to know if your deal qualifies before you even pick up the phone. So DSCR stands for Debt Service Coverage Ratio. Mouthful, I know, but the idea is stupid simple. Instead of the lender digging through your W-2s or your K-1s, they just ask one question. Does the rent cover the mortgage payments? If yes, you're in business. The property qualifies, not you. Which is why DSCR loans blew up with buy and hold investors, Airbnb operators, and anyone maxed out on conventional loans. Let's do a real number. Say you're buying a rental that brings in $2,200 a month. Your full monthly payment, taxes, insurance, and HOA included, comes out to $2,000 even. 2,200 divided by 2,000 is a DSCR of 1.10. 1.1 is a green light. Below 1.0, the rent doesn't cover the payment. You'll need more down or a higher rate. Right at 1.0 to 1.1 is standard pricing territory. 1.25 or higher, now you're unlocking the best rates and the highest leverage. And just so we're clear, the payment we're using includes taxes, insurance, and HOA. Lenders call that PITIA. Okay, rates. DSCR loans usually price a half point to a point and a half higher than conventional investment loans. That's the trade-off for not documenting your personal income. It's the price of convenience. 5 things move your rate: your credit score, your loan to value, the ratio itself, the property, and the purpose. The sweet spot? 720 plus credit, 1.25 ratio, and keeping your loan to value at 70%. Hit all 3 and you're getting the lender's A paper pricing. That's where you want to be. All right, requirements. Credit score. 660 is the floor, but 720 unlocks the best terms. Down payment. Plan on 20 to 25%. Some will go 15, but you'll pay for it in rate. LTV. 75 to 80% for purchases. Cash out refis usually top out at 70. Reserves. Lenders want to see 6 to 12 months of payments sitting in the bank. Liquid. Property condition. It's got to be rent ready. If it needs work, that's a bridge loan conversation. And one more, experience. First-timers are welcome, but you might see tighter caps until you've closed a few. Property-wise, DSCR is broad. Single-family, duplexes, condos, and small multifamily up to 8 units. And yes, short-term rentals. Most programs now accept projected market rent or a 12-month income history. 3 common uses. First, the classic buy and hold purchase, getting into the game. Second, refinancing out of a hard money or bridge loan once the property is stabilized. And third, the cash out refi to pull equity and go buy the next one. That's how you scale. One thing nobody warns you about: most DSCR loans come with a prepayment penalty, usually a declining schedule. 5% year 1, 4% year 2, down to 0 after year 5. Ask about this up front, every single time. So, how do you actually qualify? The fastest path is running your deal past a broker who specializes in DSCR, because rates and overlays shift constantly, and you need a broker with live pricing from multiple lenders. 150 of the top investor brokers in the country price DSCR loans through Relip every day. We built it for this. If you want your deal priced against every program in 60 seconds, ask your broker if they use Relip. Full written guide is linked below. Rates, requirements, calculator, the whole thing. I'll catch you in the next one.